Welcome to Trading with the Trend Part 2, presented by Daily FX Education. In the first video, we discussed what a trend is and how to locate trades when price action is at or near a trend line. We touched on different market temperaments, such as an uptrend, a downtrend, and a ranging market. Once the trend is identified, we look for trading opportunities in the trend direction. We concluded the video with the benefits of trading on multiple time frames. In this video, we will dig deeper into trend identification and how following the trend of the market can make trading seem easier. We'll also see how different indicators help identify the direction of the trend. No matter your method, an important rule is to find the most obvious trends to trade. We will explore how a trader chooses to trade one particular pair over another. We also use a similar concept of comparing pairs to trade in a range-bound environment. Finally, we'll conclude this video with how to trade multiple time frames and how much data to refer to when locating trends. Before we get started, I want to emphasize the importance of the trend in your trading. Perhaps you've heard the trading cliche, the trend is your friend. But just what does that mean? We want to trade with the trend on all of our trades to take advantage of the momentum of the market. If you have the option to run with the wind or against the wind, which would you choose? If you run against the wind, you have to work harder and you exert more energy just to finish. On the other hand, if you run with the wind, the run doesn't require as much energy and you tend to get to your destination quicker. Trading in the direction of the trend is like running with the wind to your back. It seems easier because you tend to arrive at the destination quicker than anticipated. Also, by trading the big moves in the direction of the trend and not the smaller moves against the trend, we don't have to be as exact in our entries and exits. So there's also room for error when trading with the trend, something that we need in our trading approach. Like we discussed in the first video, the best way to identify the trend is to use the market price itself and to note the highs and the lows. But many traders prefer to use technical indicators for this. Indicators can be instrumental in confirming where you think the trend is heading. Here is a daily chart of the Euro-Australian dollar currency pair. The most popular indicator to use to identify the direction of the trend is the 200-day simple moving average. The first thing to look for is whether the market is above the 200-day simple moving average or below it. The trend is considered down when the market is below the moving average. Some traders will take it a step further, and the market must be below the moving average and moving down to be a downtrend. If you're not comfortable determining whether the market is moving down or not, you can always add another moving average on the chart to simplify the process. We add a 50-day simple moving average along with our 200-day simple moving average to do so. We'd look for the 50-day simple moving average to move below the 200-day simple moving average to note a downtrend. If the 50-day simple moving average also moves down, it further indicates the downtrend. For an uptrend, look for price action to be above the 200-period moving average. Again, some traders will take it a step further, and that the market must be above the moving average and moving up for it to be considered an uptrend. And if you're not sure if the market is moving up, you can always add another moving average. We add a 50-day simple moving average. We'd look for the 50-day simple moving average to move above the 200-day simple moving average to note an uptrend. If the 50-day simple moving average is also moving up, that means that the market is moving up strongly within the uptrend. This chart includes the moving average convergence-divergence indicator, otherwise known as the MACD. The key point here is the zero line. Traders will consider the market to be a downtrend if the red MACD line and the blue MACD signal line are both below the zero line. If the red line is also below the blue line, it further indicates the downtrend. This chart includes the Relative Strength Index, or RSI. Traders consider the trend is down if the RSI is below 50. If the RSI is below 50 and moving down, that would note a strong move down within the downtrend. On the other hand, traders consider the trend as being up if the RSI is above 50. If the RSI is above 50 and moving up, that would note a strong move up within the uptrend. This chart includes the Bollinger Bands. which is made up of a 20-day simple moving average, which is the blue line, and two bands which are drawn based on the volatility of the market. Traders first take a look at the general direction of the bands to note the direction of the trend, but also look at where the market is in relation to the 20-day simple moving average. If the bands are moving down and the market is below the 20-day simple moving average, the trend is considered to be down. Here's an uptrend with the Bollinger Bands. If the bands are moving up and the market is above the 20-day simple moving average, the trend is considered to be up. While using these technical tools to help identify the trend does allow you some level of consistency, by far the best approach is to just use the market itself to identify the trend. The idea is to choose the strongest trend to increase your chance of success in any trade. There should be no doubt about the trend you choose, and with so many pairs available to trade at FXCM, there always seems to be a few strong trending markets that anybody can identify. So we compare different currency pairs to determine which has the strongest trend to trade. Let's look at a downtrending Euro-Australian dollar currency pair and add a line just below two recent lows. Now we'll do the same with another chart which is also in a downtrend, such as the Euro-New Zealand dollar daily chart. Since both pairs are in a downtrend, we look for short sell opportunities. However, let's compare the strength of each pair's downtrend. You can see that even though the Euro-Kiwi dollar, New Zealand dollar, is also in a strong downtrend, the recent activity shows the Euro-New Zealand dollar printed a couple of higher lows while the Euro-Australian dollar did not. This means the previous chart, the Euro-Australian dollar, is in a stronger downtrend of the two pairs, and we want to sell short the Euro-Australian dollar. Both pairs offered solid selling opportunities, but since the Euro-Australian dollar printed a lower low, and the strength of its downtrend is stronger, the idea is to compare the pairs you identified as being in a downtrend to find the strongest trends. This comparison makes it easier to find those stronger trending moves. Let's look at two uptrending markets to compare their strength. Here's the Australian dollar, US dollar daily chart. I drew a line on this chart too to note the difference between the highs. The recent high is currently lower than the previous high. It may end up moving above the previous high, but has not yet. The Australian dollar Swiss franc had no problem moving up through its previous high. This means that on this day, the Australian dollar Swiss franc was stronger than the Australian dollar US dollar, and the Australian dollar Swiss franc is our preferred pair to look for a buy. This comparison is more of an art than a science. There's a lot of opinion involved in this analysis. Even if you see a little differently than another trader, you're both positioning yourself to trade the strong trending moves and put yourself in a better position than those who skip this important step entirely. We've gone over uptrends and downtrends, but let's compare two range-bound pairs. Here's a daily chart of the Euro-Japanese yen. We can see that the range is identified by two similar price levels, where the market has a tendency to reverse. This is how we identify a range-bound market. I have the resistance area noted as the sell zone, and the support area noted as the buy zone. This is a fairly clear range-bound situation, which is easier to trade than most range-bound markets. Let's compare this market to the Swiss franc Japanese yen daily chart. While this chart offers some solid trading opportunities taking advantage of the range, both the sell and buy zone on the previous chart, the Euro-Japanese yen, is narrower and offers more trading opportunities. Since we place our buy stop above the sell zone when we sell, and place our sell stop below the buy zone when we buy, the narrower zone means less risk and a more predictable range to trade. There's less risk in trading tighter zones with a similar comparative reward. So it makes sense to trade on the Euro-Japanese yen since it's less risky with the same amount of possible reward. This may not be that big of an edge at first glance, but it doesn't have to be. Successful trading is just taking advantage of any edge you can find, and this one certainly qualifies as worthy of our time to find. So far, we've been using the daily chart to identify the trend, and then trading in that same direction. We start with the daily chart because it's the best representation of the market's mood. One reason is sampling. There are just more trades done in a candle on the daily chart than there are in a candle on an hourly chart or any other intraday chart. A daily candle represents the opinion of traders all over the world who executed a trade in the 24-hour session. Most of the big traders in the FX markets also use the daily charts, which means that their moves are also based on what the daily chart is showing. This combination makes the daily chart the best place to start for an overall view of the market. The daily chart is the best time frame to use for technical analysis, but some traders prefer to trade on shorter time frame charts to see more trading opportunities. A proven approach to trading is to first identify the trend on a longer time frame chart, and then to move down to a shorter time frame chart to find your trade in that same direction. We recommend using between a 4-to-1 and 6-to-1 ratio for time frames used in your approach. It's important to keep in mind that the longer time frame charts do offer more reliable technical analysis because of the number of trades in each candle. So the trade-off is that the longer term chart offers better trading opportunities, while the shorter term charts offer more trading opportunities. You just have to determine your comfort zone when developing your trading approach. We looked at many examples of trends on daily charts, so let's take a look at how we identify the trend on intraday charts. Here's a 1-hour chart of the Australian dollar, Canadian dollar. There's a series of higher highs and higher lows, which means this currency pair is in an uptrend. This market environment is good for identifying buying opportunities on the 15-minute chart. On the 15-minute chart, there are many more buying opportunities. We look to buy at the bottom of highs. This is just a small section of the 15-minute chart, which illustrates if you find the trend on the 1-hour chart, you can follow the 15-minute chart and find buying opportunities more often. Here's a 4-hour chart of the pound Australian dollar. There's a series of lower highs and lower lows, which means this currency pair is in a downtrend. This market environment is good for identifying selling opportunities on the hourly chart. Again, on the smaller time frame chart, we have more opportunities to place trades. Our goal is to trade with the momentum of the market, and the momentum here is clearly to the downside. Trading with a trend increases your chances of success. We get this question from time to time as to how much data you should consider when looking at the trend. When setting up these various time frame charts, we recommend being consistent about how much data you have on each chart. So when you look at a weekly chart, you want about 2 years of data. When you're looking at a daily chart, you look at about 6 months of data. This chart should give you a good idea as to how much data you want to look at when viewing different time frames. The idea is to have about a minimum of 100 candles on the chart to get a good feel of the mood of the market. For example, if you look at a daily chart, you would want about 6 months worth of candles. If you look at the trend on an hourly chart, you'd want about 20 days of data. To conclude, here are the important points we would like to note. Always trade in the direction of the trend. Use multiple time frames in your trading approach. Only choose the most obvious strong trending markets for your trade. If your opinion about the trend is weak, your trade will most likely also be weak. As far as the time frames you use in your approach, keep in mind that the longer time frame charts will probably offer better trading opportunities, but the shorter time frame charts will offer more trading opportunities. Find the combinations that work best for you, as that is the key point in becoming a consistently profitable trader. We hope you found this video helpful. We encourage you to attend a live webinar on trend trading with our course instructors. Instructors will relate what you've learned to current market and trading conditions, where they'll also field live Q&A on the topic of trend trading. Thanks for watching this video, and good luck with your trading.